Imagine this for a moment. You're not starting from zero. You're not hustling to scrape together your first investment. Instead, you're sitting on $1 million in cash, right now, ready to deploy. You've already outgrown beginner investing advice. You already understand that patience beats speculation, that fees matter, and that index funds quietly outperform most of the exciting strategies people brag about online. So your question isn't, how do I start investing? Your question is sharper, more strategic, more mathematical. How fast can $1 million realistically double to $2 million purely through compounding, with no extra contributions, no gimmicks, and dividends fully reinvested? That single question separates casual savers from people who think like capital allocators. Welcome to Simpson Foresight, where we look past hype and drill straight into the philosophy, psychology, and mechanics of real-world wealth building. Today, we're ranking 5 Vanguard index funds not by popularity, not by marketing appeal, but by one simple, brutal metric: historical compounding speed. From the most balanced, resilient portfolio at number 5, all the way to the most aggressive, high-velocity growth engine in the number 1 spot. For each fund, we'll explore what it owns, how it generates returns, how volatility affects compounding in the real world, and the historical range of time it might take for $1 million to grow into $2 million, assuming dividends are reinvested and taxes are deferred inside a retirement-style account. And stay with me to the very end, because the fastest doubling fund on this list has historically delivered enormous upside. But only to investors who can endure deep drawdowns without losing conviction. Because here's the truth few investors want to confront. Compounding does not reward the fastest strategy. It rewards the most survivable one. Let's begin. Before we step into the rankings, we need one clear grounding principle. Nothing you hear today is a guarantee. Markets do not move in smooth, straight lines. Real compounding happens through expansions, recessions, inflation cycles, panics, recoveries, euphoria, and fear. So when we discuss ranges like 7 to 9 years, 5 to 7 years, we're talking about historical outcome bands, not promises, not forecasts, not fantasies. We respect your intelligence, and more importantly, we respect your capital. With that in place, let's move to number 5, the Calm Compounding Machine Vanguard Target Retirement 2060 Fund. VTTSX. This fund is designed for investors who want long-term growth, but don't want to manually rebalance portfolios, shift allocations, or constantly rethink their risk exposure. VTTSX blends U.S. stocks, international equities, and a small but intentional allocation to bonds, which slowly increases as the target date approaches. Today, the portfolio sits at roughly 90% stocks and 10% bonds. That small bond component does 2 things. First, it cushions volatility when markets fall. Second, it slightly caps upside during booming years. And that's by design. This portfolio isn't trying to be the fastest, it's trying to be emotionally survivable. Dividends typically land in the 1.8 to 2% range, and when reinvested, they quietly add fuel to long-term compounding. Historically, across longer cycles, this type of allocation has produced around 8 to 10% annualized returns, depending on the period analyzed. Now let's apply that to our $1 million scenario. At around 5 years, historical outcomes often fall near 45 cents to $1.65 million. By 8 to 10 years, the portfolio commonly approaches or crosses the $2 million doubling range. So for VTTSX, a reasonable doubling expectation sits around 9 years, give or take where the market sits in its cycle. Not thrilling, not flashy, but powerful in a way many people underestimate, because portfolios like this tend to survive investor behavior. When markets fall, the built-in risk control helps investors stay put, and staying put is exactly what fuels compounding. But what happens if we remove the bonds and commit entirely to stocks? Let's move to number 4. The full market workhorse Vanguard Total Stock Market Index Fund. VTSAX. This fund represents the entire U.S. stock market. Tens of thousands of businesses working, growing, competing, and evolving across every sector and market size. You own mega caps. You own mid-caps, you own small caps, you own innovators and mature operators alike. It's capitalism in a single fund, market cap weighted, meaning winners naturally grow in influence, while struggling companies quietly shrink as a percentage of the portfolio. Dividends average around 1 to 1.2%, and when reinvested, they become a steady side engine of growth. Historically, the U.S. total market has delivered roughly 9 to 11% annual returns across multi-decade periods, sometimes higher during technology expansions, sometimes lower during recessions or stagnation phases. Now let's place $1 million into that equation. Around year 5, historical compounding ranges commonly fall between $1.6 and $1.8 million. Around year 7 to 9, many periods historically push the portfolio into the $2 million doubling zone. Compared to the target date portfolio, you've trimmed bond drag, added volatility, and likely shaved about a year off the doubling window. But you've also accepted deeper drawdowns. Full equity portfolios can fall 35 to 55% in severe crashes, and the true challenge isn't mathematical, it's psychological. If you panic sell at the bottom, your compounding clock doesn't just stop, it resets backward. Still, for disciplined investors who can hold through cycles, VTSAX remains one of the most efficient, low-maintenance compounding engines ever built. But what happens when we narrow focus, eliminating small companies, and concentrating on the largest corporate leaders driving the majority of market returns? Let's move to number 3. Number 3. The large cap leadership engine Vanguard 500 Index Fund. VFIAX. This fund tracks the S&P 500, the 500 largest, most influential publicly traded companies in America. No speculative microcaps, no thin capitalized minnows. Just global economic anchors, companies with deep revenue streams, entrenched market share, and the financial strength to survive economic storms. The weighting tilts naturally toward the winners, the innovators, the corporations defining industry direction. Dividends typically land near 1.1 to 1.4%, though the primary engine remains capital appreciation. Historically, the S&P 500 has delivered around 10 to 12% annualized returns over long periods, with some eras stretching beyond that range, and others lagging during slower decades. Now for the million-dollar compounding lens. Around year 5, historical outcomes often range between $1.7 and $1.9 million. By year 6 to 8, the doubling threshold has historically been reached in many cycles. Compared to the total market, the concentration in large, established winners can slightly accelerate compounding, while still maintaining wide diversification. But what if we stop mixing growth and value all together, and instead lean aggressively toward pure, high-growth megacap dominance? Let's move to number 2. Number 2, the high-velocity growth concentration Vanguard Megacap Growth Index. MGK/VMGAX. This portfolio is engineered for speed under the right conditions. It focuses on the largest growth-oriented megacap companies, businesses defined by innovation, scale, and the capacity to expand revenue without proportionally increasing costs. Companies with platform economics, global adoption, curves, high reinvestment rates, and long runway growth trajectories. Dividends here are extremely low, often below 0.5%. Because most profits are reinvested back into the business to fuel expansion. Historically, in growth-dominant market environments, this category has produced mid-teens annualized returns across strong cycles. But the trade-off is real. When growth leads, portfolios like MGA outperform dramatically. When defensive sectors or value factors take the lead, they can lag significantly. And in market corrections, drawdowns can be sharp and emotionally punishing. Now apply $1 million. Around year 3, strong cycle ranges may fall near 1.5 filers to $1.8 million. Around year 5 to 7, doubling has historically occurred in favorable environments, meaning, under supportive conditions, growth concentration can substantially compress the doubling window. But this only works for investors who can ride through periods of deep underperformance without abandoning the strategy when it temporarily falls out of favor. And that brings us to number 1. The fastest doubling fund on this list, and also the least forgiving to weak conviction. Number 1. The Pure Technology Compounding Rocket Vanguard Information Technology Index. VITAX. This fund is not diversified in the traditional sense. It is highly, unapologetically concentrated inside the technology sector. Software, semiconductors, cloud infrastructure, digital services, AI, data processing, cybersecurity, and automation. This sector has historically produced some of the strongest long-term returns of any equity category, driven by scalable economics and relentless innovation. But that same force creates enormous volatility. Dividends here are almost negligible, typically around 0.3 to 0.5%, because capital is channeled toward expansion rather than payout. Across explosive market eras, tech has delivered 15 to 20% annualized returns. But it has also suffered historic crashes, the dot-com implosion, the 2022 valuation reset, multiple rotations where capital fled risk assets overnight. This fund rewards patience, but punishes impulsiveness. Now for the $1 million profile. In strong expansion cycles, years 3 to 4 can historically reach $1. 6 to $1.9 million. Years 5 to 6 have seen multiple historical doubling periods. But in adverse cycles, capital can stagnate or drop steeply for extended stretches. So yes, VITAX may offer the shortest historical doubling path, but only to investors willing to endure some of the harshest drawdowns in modern portfolio history. Fastest upside. Fastest feedback when discipline fails. Timeline recap. Realistic doubling ranges VTTSX, roughly 8 to 10 years VTSAX, roughly 7 to 9 years VFIAX, roughly 6 to 8 years MGK, roughly 5 to 7 years VITAX, roughly 5 to 6+ years in strong environments with high volatility risk. Your doubling speed is not determined only by the fund you choose, it is determined by your ability to hold that fund when markets test your conviction. Because compounding isn't a race against time, it is a test of emotional endurance. So, which fund should you choose? If you value stability and automatic risk shaping, VTTSX aligns with that temperament. If you believe in broad U.S. economic expansion, VTSAX remains a timeless workhorse. If you want exposure to dominant corporate leadership, VFIAX offers disciplined concentration. If you're comfortable accepting higher swings for potential acceleration, MICH may fit your style. And if you are one of the rare investors who can withstand severe sector drawdowns without flinching, VITAX may offer the fastest historical compounding trajectory with the highest psychological toll. Wealth is not built by chasing the fastest chart. It is built by choosing a strategy you can hold through every season. Bull markets, crashes, boredom, and uncertainty. And letting time do what time does best. Your $1 million doesn't need adrenaline. It needs discipline, patience, and conviction. Your compounding clock doesn't start when you find the perfect fund. It starts when you finally commit to the one you can hold. This is Simpson Foresight. Thanks for spending your time here today. If this exploration challenged your thinking or sharpened your strategy, stay with us. There is much more to uncover about the art and psychology of long-term investing. Until next time, invest intelligently, think in decades, and let compounding work quietly in your favor.